The drive of every economy is the push of interest in people exchanging their values in the market. There is a progressive update in the way the market is being run and how effective it can be to society. Every businessman or businesswoman wants to build a successful market or stock that can be branded in a very valuable way. There is a secret in the market that might not be visible to everyone, and it is that we don't really exchange goods and services in the market, we do exchange value. What drives the market is not really the quality of every goods and services, but it is the value attached to them. The visible change we can see in our markets today is the effect of civilization and technology. More people are now investing their time and resources on trying out new things and inventions. It is these new inventions that cause inflation in the market. The value of money does not really depend on the scarcity of goods and services, but it is in the state of the economy. There are some important questions from many businessmen and businesswomen, and the questions are based on the fixation of price. As a norm, if the price of goods and services can be fixed for a longer period of time, then we will have a balanced market, and then a balanced society. What this video will do to you is to open your knowledge to how home prices will change forever and why it will change. Haven't you subscribed yet? Click on the like and follow tab to subscribe to this channel for more exciting and fascinating stories. I'm sure you must have done it. So let's get right therein. Home prices will change forever 2023. Sellers in the panic mode. The worst experience of the disaster that happened in 2008 is what most house investors fear might happen again in 2023 or even worse than that. Many feel uncertain about this unwanted scenario due to the data showing that nationwide prices are going to go down evermore. This can be true because the most trusted and the most famous data machine index in the United States, called Cash-Miller Index, indicated that the home price increased with about 2.5% between 2022 and the start of 2023. With the stats, many are concerned with the rate at which the price increased, with the data also showing that 38% of houses was purchased during the pandemic. This indicator is what most investors believe to be a lagging indicator because the desperation at purchasing houses have greatly increased between 2021 through to the end of 2023. If you are so much curious to know more about this, you will find out that the index also showed that most of the house purchased are on 3 months moving average logarithm. In case you are doubting this stat, Redfin, a leading state housing leasing platform in the world, they are also regarded to have the highest selling housing assets in the works. Not only is their facts accurate but very vast and acknowledged across the globe. Redfin showcased and highlight sometimes in 2922, which reads in October 2022. U.S. home prices were up to 5% compared to the last year, selling at a median price. The site showed the list of prices of houses that were purchased by investors and private ownership. The data shown in the site illustrated a price contrast, particularly between May 2022 and June 2022. It was reported that there is about 1.6% increment in the Housing Lease Index. This contrast in price created a great inflation in the housing business market in that period of time. This is a huge difference in the world of investors, and this indeed started the cause of their panic. 13% reduction in the bill money is a great signal in the world of investors that the housing leasing index is starting to be uncomfortable. And this should also tell you all you need to know as regards the future of the housing labor market. There is a large signal that a significant crash is on its way in the real estate investors' world. A famous real estate investor, Andy Flonitz, claimed that his team thinks that home prices will fall closer to 20%. People who think the price will fall to 10% are just dreaming. 20% tip is probably comfortable. We also have institutions after institutions also making similar comments. KPMG, one of the largest and most respected housing company, just announced that they expect the housing lease to drop to like 20% in the first quarter of 2023. It is also reported that some places in the U.S. where the pandemic mostly affect are going to have the reduction more than 20%. For instance, a city called Boise, Idaho. This is twice the number of percent recorded in more than 2 years earlier. You can start to imagine what next for the housing labor market. So, what's next? If Redfin showed us that there is 13% decrease in house lease in the year 2022, then we should likely look into the new prospects that the world of investors will now dive into. The root cause of this reductions can be traced to the event in 2008. Everyone knows that the major factor responsible for the downturn of house lease in 2008 was bad loans, and this was plainly demonstrated in the movie The Big Short. This happened because bad loans as at then was too easy to obtain. Many people were buying or purchasing with few incomes that don't merge the amount of debt they are loaning. Many people lobbied into the business of leasing homes based on their given conditions. Perhaps the loan conditions and rules now changed. The loan system is practically not in existence again, and that have drastically affected the rate of purchase, thereby affecting the price. Another consideration that have been figured out to be a key solution is the investor's withdrawal. It has been reported that in the last 12 years, some new investors have come in and changed the system of operation in the house leasing system. Some other big investment companies like OfferPad, Zillow, and Opendoors have started pumping too much money in the house leasing systems over the years, and this have caused a great deterioration to many private ownership. This is essentially called high buy program. It is a business where an investor can bargain a house at a few amount, and then these big companies come and purchase the houses in huge cash. This have raised a big concern in the labor market, that big companies are now buying houses at the rate much higher than their current value. What they now do is that they buy many houses with much thousands of dollars, and then they start leasing in high amount. This worked for many years and changed the entire market value for the lease of house in the United States. This was the cause of the increase in the data shown in the Redfin chart at the end of the year 2022. Small companies then buy a house, change the furnitures and the floor patterns, paint the rooms, change the horticulture arrangements, and then resell at a very high amount. Data showed that between 2020 and 2022, over 71% of houses were either leased or sold by investors and at a higher rate. The point is that both the big and small investors at a time in 2021 have taken over the house labor market and then dictate the algorithm of the housing system. The investors have taken the system into their advantage and made private ownership to be less attractive or affordable. Now, the question is what happens if all the investors suddenly pull out at the same time? It will mean that the data that shows the increment in the data chart will convincingly show the opposite. The only way to combat this is to look into how these industries get their loans from banks and then stop the operation. For instance, when you look at companies like Opendoors that lost approximately $928 million in a few months, it is easy to suggest the future of the labor market. It is claimed that the company is on the verge of bankruptcy, and the reason is very clear. They leased a considerate number of price, and the return was at the reduction of more than half. If we can give the big investors tough time by claiming ownership of our rights in the labor market, they will quickly bow out and the prices in 2023 will remain under control. The value of market is not determined by the one who sells but by who buys. Private ownership can go back to how the real estate started to bloom high up in 2008 and continue that legacy. The housing loans should not be given to investors again, and the corporation in charge of housing should give priority to private ownership rather than investment companies.